Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. I am so proud to be partnering with the Scotiabank Women Initiative for this episode. Now, if you're not familiar with the initiative, they help women to grow their business, advance their careers, and invest in their futures. And through this partnership, I'm going to be interviewing some of the most influential women at Scotia. But we're going to be doing the same thing we do in all our episodes, which is looking for investment ideas and helping you make money. In this episode, I had a chance to speak with Swanzy Quarshie. She's a managing director of equities at Scotia Wealth Management, and we talked about the best way to think about investing in AI. So let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Swanzy Quarshie, thank you so much for joining me on the podcast.
Thanks for having me. Great studio.
Oh, thank you very much. Yeah, no, it feels very aesthetic. I think the vibe I was going for was finance bro, but make it female.
Fits.
And it fits to have you here. You're with us as part of the Scotia Women's Initiative, but I also just want to get a sense of your career arc. I mean, now you're the managing director of equities at Global Investment Solutions, just a huge umbrella. I imagine billions and billions you kind of are helping to direct. But how did you get to this point? What was your career journey in finance like?
Well, it was definitely fun. I gained a lot of experiences along the way and met a great network of like-minded women as well as men that were very supportive of me along the way. One of the key areas I was in was on the buy side, managing energy mandates for an independent. I was there for about 10 years. And after that independent was acquired, I found myself looking for my next role. And one of the most important things for me was to find the right platform. And there's so many reasons why Scotia is a great platform. You mentioned the Scotia Women's Initiative. It's definitely one where it's a platform that really just allows people to explore different aspects of jobs in the financial markets.
I mean, your career is a great example of that. I remember when you were a portfolio manager, you used to come on BNN all the time.
That's correct.
And you were given stock recommendations. And I imagine the audience loved that because I know Canadians love their energy stock.
100%. And I loved it. It was such a fun career.
And now you're like a little bit more big picture.
Big picture. I started off first at Scotia back in energy, just given the same kind of recommendations, but to our institutional equity clients. And I moved to wealth a little bit over a year ago, more of a big picture, looking at the equities market broadly, both here in Canada, US, and international. And essentially working with a team that provides guided portfolios for our relationship managers to use for their clients.
Yeah. So as I said, all these advisors are thinking, how should I structure their portfolio? You're kind of in deep within Scotia and offering that guidance to all of those advisors. So let's talk about what that looks like these days. We've got markets that are robust.
Correct.
Let's call it. And historically robust.
Yes.
When you look at valuations and, AI seems to touch everything. How do you think about this point right now? Are you nervous? Are you all in? What's your view?
Well, I mean, all the research shows historically that earnings growth is a key driver for market performance. And earnings growth is very much tied to GDP. Right. What we're seeing right now is a little bit of a decoupling of that. That's the part that makes me a little bit nervous is that we're seeing really, really strong equity markets without the economy being as strong. And that's not just here in Canada. It's also in the US. It's also international. So that makes me worried. And I know you want to talk about some of the reasons why we're seeing the strong equity markets, but obviously you brought up AI. That's a key thing that's happening in the US right now. We're seeing a lot of movement in technology stocks, and not all of them are necessarily profitable. A lot of them actually are not. And then in Canada, obviously, we've seen a huge movement in equity prices driven by another theme, which has been on the gold side. So
I mean, it's been just tech and gold.
Tech and gold. And you know what? I should add a little bit of infrastructure to it too.
Yeah.
When you look at international on the European side, right? So there's a few themes that are really driving the markets right now. And if we don't get the economy catching up to be as robust as the performance, then that's where you see the potential for a pullback.
Yeah. How do you think about which way it's going to break? Because those that I see defending the market valuations and defending the market rally, they are leaning towards, obviously, the economy is going to catch up.
Yeah.
And that's where the reconciliation will happen. The E in PE, the earnings will rise to meet the P, the price.
Yes. So we're cautiously optimistic when it comes to AI. Definitely, it's very transformative. And it's not a new technology. It's something that's been worked on for a very long time. The question is, how big of a gain is it going to be? How big of a win is it going to be on the productivity side? We need to see some big wins because there's been some big promises that have been made, right? You look at some of the consultants that have talked about this. We're thinking about things like adding 15 trillion to global GDP in a few years, right? So if we don't get that 15 trillion plus, then obviously we spend a lot of money to build a lot of infrastructure without that GDP performance.
So let's pick up on that point, because earlier you were telling me on a global perspective, with all the assets out there, you're actually slightly underweight equities. Help me understand why that is.
So it's a very slight underweight position, and it's actually really driven by being underweight to Canada, and again, very slightly. But we're still overweight on the US. We are neutral and international, so it is quite small. But the main driver being that Canada underweight, and part of it is just what we see in Canada. Like as I mentioned earlier, Canada is doing really, really well right now, and we are quite optimistic about some of the potential that Canada has. But it's still a very cyclical market, a very cyclical index. So the index quality, when you look at it compared to other regions, you have an index that's really, really geared towards a lot of things like natural resources, obviously gold being one of them, but on the energy side as well. As much as we love energy, and energy is a key driver for the economy, for a company that's producing energy, you're a price taker. And that really, we prefer companies that really have sustainable competitive advantages. And so when you look at the Canadian index, it doesn't offer us many companies with sustainable competitive advantage.
There's an intersection here. You mentioned energy, which is obviously your background, and AI, which I can tell you're spending a lot of time thinking about at Scotia. All this energy demand that is going to be needed to fuel basically these data server farms that help enable the technology. Help me understand I'd love to know your perspective. Like, how do you think about how much energy is going to be needed and where that's reflected and where it's not reflected in the markets?
So this is where Canada has some advantages, right? AI needs a lot of energy. It needs power and it needs water. And so that's where Canada has a ton of abundance. But it's interesting because the companies are really a lot more ambitious than what we can actually sustainably produce or provide in terms of natural resources, right?
Meaning the hyperscalers.
The hyperscalers
are more ambitious than what we can provide.
Exactly. So our partners at Scotiabank Global Banking and Markets wrote an amazing report on the data center needs, and their title of the report was "The Math Ain't Mathin'," and it's very true. Like you look at, I think it was Eric Schmidt that said to Congress that we're going to go from a situation where AI, the data centers only rely on are 3% of the power demand in the U.S. to 99% eventually.
Oh my God.
Right. So that means
where does
the power come from? So that's where there are limits there, but that's where it's great for energy producers eventually, because they have to supply that power. Now, when I say energy producers, I'm not talking necessarily about the crude oil producers. but it's natural gas power that's going to be really the driving force to bridge us for that power demand that these data centers need, and they are extremely power hungry.
I mean, that's going to cause some distortions as well. And I know a lot of people are talking about it as well. Like, am I going to be fighting with Meta,
Yes.
for to power my house? And then who can pay the higher bill? Obviously, it'll be Meta, right? Like, is this going to lead to a worldwide increase in electricity prices? That's not good for society either.
Yes, there's definitely. So the interesting thing about AI is that I think a lot of people forget that AI is also, it's really intensive on everything that we rely on. It's intensive on water, it's intensive on power. So there is going to be an element of competition that we're seeing right now, but the hyperscalers are also working on ways to work around this. The question is, can they do it fast enough? Because they're really growing very, very fast in terms of their infrastructure build outs. But can the power get there fast enough?
And this, I guess, all hinges on, like, because this stuff isn't even built, right? This is all promise to build, and then we'll see what the demand is. So you have to see what the demand is.
Yes.
Like, maybe it's not at the scale of the investment.
Right. And that's a big question. That's where the concerns about, is this a bubble, comes in, right? Because if the adoption and the integration of AI does not happen to the extent that we're planning and building out infrastructure for, then we are going to have some stranded assets. The great thing is that a lot of this build out right now is happening with companies that really have a lot of capital, right? So
they're not the money losing tech companies.
They're not exactly.
They're not spending out of cash.
They're spending out of cash, but they are also leaning on the debt markets. So that part is true. But they are legitimate companies with legitimate businesses, with legitimate cash flow. So we feel a little bit more confident about that. The question is, what does AI productivity gains actually look like, and how much of the economy is going to truly adopt AI into the economy?
Is there a sense now to get like an early read on what that could look like? Like, how do you think it's going to break?
Well, there's certainly some aspects of the economy that we're already seeing some AI type gains from, where you look at, especially companies in the financial services world, for example, it's really right now it's AI integration. So any part of the economy that's really intensive on data and lots of replication, that's where you can use AI a lot for advantage for those kind of those parts of the business, right? So it really does have some benefits that we're seeing right now. But in terms of actually economic expansion, there's two forms that AI can help us, right? It can increase economic activity. It can improve the just growth that way by increasing revenues for a company, or you can cut costs. So on both sides, we're starting to see especially on the financial services side, companies really talk about how they're integrating AI to help on both fronts. So the potential is definitely there. We just need to see it in more aspects of the economy.
I mean, a lot of people can argue. They can argue themselves into this investment. They can argue themselves out of this investment. Yes. Like, either we just don't know, to your point.
Yes.
I mean, you're overseeing this stuff, you're studying it. And even you are saying, like, we just don't know.
We don't know.
How is it going to break? Because it could have such huge potential, do you have any choice but to be invested in particularly the stock market?
So there's many parts of the value chain. So there's a lot of different ways to participate in AI without, I guess, going after the most aggressive, low quality companies. And that's how we tend to think about it. But I think longer term, there's definitely a reason for people to be invested in the equity markets especially. And that's because whether AI lives up to all the promises that have been made so far or not, we do know that AI integration is real and will continue. Now, we might have overbuilt to some degree if it doesn't really materialize in exactly the way we think it will. But because AI integration is real, that means that there's going to be more gains to be made on the capital front, especially as you think about AI displacing some of labor, for example. So when you've got more returns being driven by capital, that's really good for the equity markets, right? So you want to be invested in the equity markets to make sure that you gain from what's happening in AI. And for me, I'm not even necessarily concerned about being in the companies that are directly exposed to AI today, because the only way that AI is going to really benefit the economy is if the rest of the sectors in the index are benefiting from AI. And without that, then AI doesn't work.
It also has to be cheaper, don't you think? Like, it can't just remain this super expensive thing. Otherwise, it will be hard to scale.
100%. And my concerns on the scalability of it is not even on just necessarily cost, but part of the cost is it's driven by the finite resources that we rely on, right? So the scalability of it really is the key concern is just how energy intensive it is. So if we can find ways around the energy intensity, I think we could get to a point where it becomes more scalable and cheaper. And as I mentioned, that their hyperscalers are thinking about some of this stuff, right? One of the reasons why they are attracted to Canada, for example, is because of our cooler climate. And that cooler climate allows them to cool their data centers with outside air versus just with air conditioning, which is really power intensive. So all of that, those kind of moves that they're making makes it a little bit less reliant on water, less water intensive. I think these things will help to make it cheaper in the long run, but we have to get there.
I mean, the country has to get there too. Like, how can Canada position itself to take advantage of this? I mean, it's not enough that a Canadian is the godfather of AI and Jeffrey Hinton. Yeah. All of those economics generally are flowing south of the border. Like, how do we get it back?
Yes. So it's interesting because I mentioned the index. The Canada's index is a lot different from US's index, right? And one of the things that makes Canada's index a lot different is because we have the natural resources, but we don't have as many tech companies. And all the tech companies are the ones that are really driving this right now. So Canada is really, the role that Canada is going to play is more on the natural resources side. That's what we see right now. Mm-hmm. There is an opportunity potentially for a tech hub within Canada. We are seeing a brain gain in Canada. So there's definitely a potential that we get some new startups that are using the new technology as the advantages of the new technology just becomes more and more visible. But we're not there yet. Right now, we're still in the phase where Canada's role seems to be building data centers in Canada, our energy infrastructure, our natural resources, our water, and that's where the hyperscalers are looking north for.
I mean, maybe you can see it in the IPOs. Like, just IPOs have come south of the border in Canada. I think you're still more likely to go private than you are to go public. We also need to do a better job, I guess, of seeding and allowing those kind of startups to grow in the country.
That's very true. I think for a lot of companies that go south, part of it is because that's where the capital is, right? And the great thing is that a lot of Canadians are also recognizing that there's great opportunities outside of Canada because companies outside of Canada are there for capital. So we're seeing a lot more people being interested in U.S. equities, for example, whereas historically it's been more home country bias.
I mean, the thing about U.S. equities that we were saying at the beginning of the year was like, wow, they're lagging. And we were, waving our flag and saying, look, Canada's finally outperforming. And we've had many guests come on and say, this is the beginning. It's going to be a cycle of outperformance led by commodities. But honestly, the NASDAQ's up 20%. Mm-hmm. At one point, it was down in 2025.
Yes, I remember.
It was down that much. Yes. So it came back to put up a gain of 20%, now basically neck and neck with the Canadian markets, outperforming the European markets, which already had a bit of a head start. I think there was an excitement to see other markets other than the U.S. outperform.
Yes.
And just the fact that the U.S. markets have come back so much and you're so excited about AI, does that support the idea? I mean, you guys are overweight U.S. equities. Right. Does that support the idea that where are we going to see these gains first? What's the first market that this is going to hit?
Correct. So I think it's not even just where we're going to see the gains first. It's also going to be the sustainability of those gains. We have a quality bias, and we want to be invested in companies that have long-term sustainable competitive advantages, right? And when you think about that, you might get a short term in some of the resource-based companies. But I was in energy long enough to know that when you get very strong markets, you tend to get a supply reaction. And that also then drives the prices to go down. The best cure for high prices is high prices, right? So when that happens, you get a lot of volatility in returns. So we like U.S. markets generally just because there's a lot more companies that have the characteristics that we look for.
And your faith wasn't shaken in 2025 when you did see them underperform?
No, not shaken. I think it's healthy to see that even though right now U.S. market performance is being driven by lower quality, low profitability companies, especially on the technology side, as I mentioned earlier. It's nice to see the breadth kind of extend beyond the MAGs, right? The MAG 7. So that part is definitely a positive. We're seeing U.S. utilities also really start to do well out of this data center build. So
what is the next wave? People are going to be looking beyond the MAG 7. Like Apple and Amazon actually haven't done anything this year.
Yeah.
Their stocks are flat. They're around records. So they have that, but they're up just a couple of percent in 2025. What is that kind of, and I know they're not thought of as the traditional AI stocks, but they're in the MAG 7. What is that? What comes after the hyperscalers, the NVIDIAs? Like we've seen these cycles before. The internet era is a great example. Like what comes next?
So that brings me to the point I made about the sustainability of performance, right? So what comes next, I think, is the rest of the economy. There's 490 companies outside the top 10 that are definitely worth having a look at. And that's part of the reason why we like the US is that when you think about valuations, the rest of the market is not as frothy as the ones that are really involved in the AI, the hyperscalers and the build out of AI. So we like the U.S. market. Like there's lots of great companies in the consumer staples and discretionary, healthcare, in financials. So that we're going to need to see those kind of companies start to talk about the benefits of AI for even the top 10, the ones that are moving on AI to keep moving. Because at some point, it has to benefit the rest of the economy.
That's right.
For the build out to have made any sense.
And not disrupted their business model.
Exactly.
That's going to be key because there's definitely parts of software. You think, tech, buy everything tech. No, actually, there's a big group in software.
Exactly.
Because now I can just do things on ChatGPT or Grok, whatever it's called, that maybe you had to pay Salesforce or somebody to do.
Exactly. No, even within technology, like you said, there's aspects of technology that have not necessarily moved. And we pay attention to a lot of those things. Like one of the parts on the technology side that we continue to like are the consultants, for example, because I said earlier, in order for this to keep working on the AI side, it has to be really well adopted by the rest of the economy. And who's going to really push that adoption is going to be the consultants.
I know a lot of people think that I think consultants will be disrupted because you don't need them. And those are the people that don't realize the middle manager.
Yeah.
Doesn't even know how to download a podcast.
Exactly. You know what? The
tech savviness might not be there.
So it's interesting how the markets are reacting to news like that, or information like that, or perceptions like that. You get a lot of people get crowded into a trade and then exit a trade really, really quickly. But the way we think about it is that all these companies have such strong relationships and are able to also adapt their businesses to the point where AI is also beneficial to them. And let's not forget that most of the economy is the true economy is actually small businesses, right? So small businesses that are going to need AI and are also going to also need the consultants to help them. So I think the write-off is happening just because everybody's so excited about the companies actually building the infrastructure.
Swanzy, what a great place to end. Thank you so much for joining us.
Anytime.